Hello friends, welcome to my channel Teacy Street. How inflation affects the stock market. Periods of high inflation usually lead to lower returns on the stock market because higher inflation is likely to lead to higher interest rates, lower economic growth and lower dividends. Firstly, the inflation rate increase, the central bank is likely to consider rising interest rates. Higher interest rates will increase the cost of borrowing and lead to lower investment. Also, with higher inflation and higher interest rates, many firms will face higher costs of production, leading to poor profitability. All these will lead to lower than expected economic growth and therefore lower share dividends, reducing demand for shares. Secondly, the periods of high inflation will cause greater uncertainty and discourage firms from the making risky investment decisions. This uncertainty can lead to lower economic growth and lower profitability for firms, making shares relatively less attractive. In periods of uncertainty, investors may pull out of shares and put a higher percentage of their portfolio in safer options such as index linked government bonds or physical assets that hold their value, such as real estate and gold. A good example is the high inflation of the 1970 led to poor returns on shares. During the high inflation period of 1969 to 1982, the real return of shares fell 11.6% according to data Creek Research. Bonds versus shares. Many investors are looking for the best yield on their investments. If interest rates rise, bonds become more attractive compared to shares. In the period 2009-20, interest rates were a record low, close 0%. Therefore, investors were recalculated to buy government bonds and save money in the bank accounts because the interest rate and therefore return was close to zero. The period of zero interest rates made shares how much more attractive because at least with shares there is a possibility of getting good dividends that more offer more than 0%.